Now we're going to go practice some more collars because I got you all excited. I got you all excited about a strategy that I love, that I used, that I implemented, that I studied. And once I understood the strategy and understood the math, I got it. And math is the key to making money in trading. It's about risk management. It's about capital protection and preservation. And it's about being smart with where you're getting in, what you're doing, and how you're doing it. Okay? So I want someone to randomly pick a stock for me. I want this company to be something that you use, love, understand every day, a company that we all interact with. Jose L says Costco. All right, so we're going to go do Costco. Perfect. Donna also said Costco. So Donna, my dear, give me a year, preferably something nice and far back away, but whenever year you want, you tell me. 2011. All right, cool. All right. Kyle, give me a month. Mike, give me a day. October. So we got the 10th and we got the 19th. So the 19th of October, 2011, going to click go to, and I can't even see the chart. So I'm going to click bar replay. You guys can notice that I can't even see the candles. I'm just going to select October 19th. I can't see anything. I have no idea what it does. Now, again, obviously we all know that Costco goes higher. That's beyond the point. What I'm going to do is just simply show how I would enter, where I would enter. I'm not going to use any lines for this. We have over 8 hours to go on this back trading session. All right, 8 hours. And as we're going to go and as we're going to progress, we're going to talk about how we can actively trade this as a collar. So what I'm going to do first and foremost is just look at where we're at and draw some lines. All right, we got a support resistance there. We got a support resistance there. We got a trend line like this. Sweet. Those are 3 lines that I will use. And we're going to use, remember that $28,000 that we started with in hour 1? We're going to go back to that. But remember, we made a 10% return in that account. So we are going to start with $30,000. And we're going to put eggs in baskets. So here's what I'm going to do is I'm going to buy at 83.58. 30,000 divided by 83.58. So eggs are going into some baskets. 30,000 divided by 83.58. 358 shares. And I'm going to look at this and try to determine if once this fills, I will create a level of where I will buy a put. So now let's go forward in time and figure out where we're going to buy. Now, does everyone understand why I'm buying here? Even if you don't, I'm going to walk you through it. So the main reason I'm buying here is because we have a resistance, we have a resistance, we have a resistance. We've broken through resistance. We have a big candle, and I'm just looking at buying this retest and buying this pullback. That's it. Done and done. Okay, so the next candle, here we go. Next candle comes in. We're not filled yet. We're not filled yet. We're not filled yet. Not filled yet. And we're filled. Perfect. So we had to wait 5 days. And we have bought $30,000 at $83.58 for 358 shares. Okay, so Costco, we bought some shares. So what I'm going to do on Costco is I'm only going to buy my protective puts if we break below this candle here. And so if we do that, we're going to calculate where, and we're going to talk all about that stuff, and it's going to be good. Okay. So here's the next candle. Perfect. Oh, I couldn't have scripted this better. I'm glad I have these cameras rolling. My boy Calvin can come at any point in time and see if I'm cheating on this. All right, team, just bear with me for a second. I'm getting all pumped. This is when I start to get my runner's high. Jack Smith, you here? So this is what you refer to when you're doing an ultra marathon. It's like you're feeling good, you're in the zone. That means that there's going to be a nice wall coming up in about 4 hours. There's a wall coming, but right now I'm feeling great. The low of this candle is 82.11. or what was the entry for my protective puts? 82.07. So that's a fantastic spot. So for me, I now know I've placed that perfectly. So what I'm going to do is I'm going to write this in. If Costco breaks below 82.07, I will buy the $80 front month put. Front month usually means 6 weeks or less. Okay? That's it. Now we have a nice little hammer here. So if we can go higher, keyword if, then we're going to look into selling some call options. And oh yes, let's go. Bang. Get it. Let's go. Who's up? Yeah. Nice little bull candle, a little bit of indecision. We made a higher high. So now what I'm going to do is something that's really, really cool in Thinkorswim. I'm going to go look at how much option premium is here, and I'm going to go try to get into, you ready for this, ladies and gentlemen? An almost unlosable trade. That's what I'm going to go look for. So now I'm going to go pop up Thinkorswim, and I'm going to show you how you can all do this as well. I'm going to click on Analyze, and I'm going to click on Think Back. Type in F4 if you did not know that you can look at the option pricing in the past. So you can back trade options this way. So you can literally look at what the option pricing would have been on almost anything. Wow, getting a lot of 4s. All right, cool. Well, there goes your weekend. Ayush says, can you do it on IB? Not to my knowledge. I haven't found a way. No. I'm not saying it doesn't exist. I'm just saying I don't know how to do it. But you can get a Thinkorswim account for free. So we're going to go type in the symbol Costco. And I got to go back to the date that I'm doing it. So that is, what day is this? October 27th. So we're going to go to the date. October, what was it again? 27. Okay. October 27. Okay. Here we go. So what I'm going to do is I'm going to look at some information here on Costco. And what I'm going to do first is I'm going to look at January. And I'm going to look at my call option of, so the stock is at 85 presently. So I can sell a $90 call for $1.25. This is for January. It's probably a little far out, but let's do it. Covered call, $90. And I'm going to get $1.27 in credit. Let me just make sure that's correct. Sorry, $1.20 in credit. $1.20 credit. This is January. Okay, perfect. And then I'm going to go look at the put option, and we're just going to analyze some stuff here. So an 82.50 put I could pay for November costs 80 cents. Okay. A December $80 put is $1.10. 82.50, which is, we're getting pretty close, is $1. Okay, so that's a debit. So we don't really want that. So let me go to January 80. Okay, so these are all debits. So what I'm looking for right now is how much would it cost for me to buy an option so that I don't really spend a lot of money? So the answer is nothing. So I might have to wait a little bit more. Okay, let's do that. Let's wait for another day, see what happens. We have a retest gap, 2 bull candles in a row at a resistance. My expectation is this is about to occur. Let's find out if that happens. Okay, there's an inside candle. There it comes. Wow. Surprise, surprise. Would have never imagined that that was going to occur. Big shock. Now, team, how do you think that I analyze this to happen? It was all based on the sentiment of this candle and that gap at a resistance. So again, we're going to buy some puts if we break below this bull candle. We still haven't done it. Compressing. So I'm still waiting. I'm waiting for a good bull candle to come out of here. We just got the dividends, so that's nice. Bear candle. So here we go. We're about to buy this put. Maybe. Still waiting. Still waiting. Still waiting. Okay, so now we're in puts. So let's go look at, this is the front month. So that means in November, I would have bought December. And we did the $80. So let's just go look at on November 17th, how much that's going to cost. Okay, November 17th. Type in a 5 if this is already cool. You're like, man, this is so sweet that you can do this. So an $80 put is going to cost $1.60. All right, $1.60. This is my debit that I'm spending on 400 shares, 4 contracts. That's how much I'm buying because you can't buy half a contract. So you're either going to overinsure or underinsure. And this is until December 16th. So that's going to protect me until earnings. Earnings, it looks like, is December 8th. So I'm going to hold this contract, and we have 2 choices. But again, for education purposes, because all we're doing right now is back trading, and we're back trading based on education. You know, we're here to learn. I'm going to draw a horizontal line. Here's the horizontal line right there. And that horizontal line is the expiration for that put. All I'm going to do right now is press play, and we're just going to go to the expiration of that so I can talk about what would have happened. All right, that's really it. Because this is a learning. This is the only way to learn. We're going to go to the expiration. Okay. Okay, so we got in our put. And again, we're just going to go, we went all the way to expiration. So we had insurance over earnings. So what you'll notice is it went up and it went all the way down. So we're back to exactly where we started a month ago. Now, here's a very, very interesting fact. These are $80 put options. We got into this position on this day here. On this day, you would have been profitable on those put options, right? Because again, a put option makes money as the stock goes down. So that means during this time frame here, if you wanted to buy that put and then eventually sell that put, you could have. If you hold all the way until expiration, what happens to your insurance? So the cost of this put is now 0. You lost all of the money you spent on that insurance. Okay? You lost all the money. Now, the reason I just press play so that we can see what ended up happening is because this is where I would have absolutely gotten into a collar. And I would have gotten into a collar on this day right there, because that is 3 up days in a row. Those are when I sell my call options. 3 up days in a row. And I would have sold January 190. Sorry, I would have sold the January $9 call and I would have brought in a credit. But for now, just for educational purposes, what I'm going to do is I'm going to write in a box and I'm going to say that we lost 400 times 1.6. So 640. We lost $640 so far on this trade from premium. Because this option that you bought, ladies and gentlemen, this insurance that you bought expired worthless. So again, this is an insurance contract. It gives you the right and the capability to sell your shares of Costco at 80, no matter what Costco does. So if Costco goes to $40, you can sell your stock at 80. All right, cool. I think you're all track with me so far. So this is gone. This is gone. I'm going to take this line off and I'm going to go ahead and draw another support and resistance that I think is kind of taking place. Something like this. And I'm going to say, you know what? I'm going to wait for my put option. I just bought one. I just lost $640. I don't want to do that again. Let me go 2 or 3 more days and I'm going to start analyzing what I actually see on Costco. So we have a good bullish gap and go on this day. I like that. If we can make a new high, 2 more of these in a row, I'll sell a call option. All right. Another bull candles. That's another up day. So that's 2 up days in a row. That's not an up day. So inside candle. All right. So we have an up day. So this is good. We're now getting into positive equity, which is the goal of me to talk about this collar in just a moment. So we have an up day, another inside candle. I need 3 up days in a row. So we're still waiting. All right. Another up day. So we have 1. Wow. big close. Okay, this is interesting. We had a very nice hammer here. We had a few good bullish gap and goes. This candle closed below all of them. And again, we have $30,000 of our money in shares. We have closed below a neckline. Is there a way for us to protect ourselves in case the stock continues to go lower? And the answer is yes, we can buy puts. So I'm going to buy puts again at 80. I'm going to buy puts for the $8 strike when, if Costco retests 81, 83, and we are going to spend money on the insurance. So now I'm actually back trading a little bit more specific, right? I'm kind of going day by day as you actually would. So with this candle, 81.83, right? Next candle, it gaps down. We don't even get the retest. It just kind of moves without us. And now it's starting to come back almost to our price. So let's say we're going to wait for it to actually hit our number. All right, on this day, this is January 23rd, we're going to buy our put. So we've retested that level. January 23rd. Jill says, is a bullish gap and go a bull candle gapping up? No, ma'am. Bear candle gapping up. Bear candle gapping up. Okay. So we're going to be buying the front month expiration, which is February. And we're going to buy an 80. So that's going to cost us 85 cents per contract. Cost of 85 cents times 400. So there we go. And since this is a collar, what I'm going to do is I am going to sell an option. Even though we don't really have 3 up days in a row, I'm going to sell a call option so that I can go get paid more than that costs. Because I just lost $640 on insurance. I don't want to do that again. So I'm going to go and sell a March call. And it has to be above where we bought our stock. So we bought our stock at 83.58. So we have to sell a strike price above there. If I sell the 85, you'll notice that we're not getting paid any money. We're not getting our 85 cents. You guys follow me so far? So that means I have to go farther out. So let's go to April. So April, if I sell the 85, I actually at least I'm getting a net credit of $1. Let's call it $1.26. So let's do that. We're going to do a covered call sale. Alan says, Jeremy, I don't understand why you would sell a call. Well, let's talk about it in more depth. I'll write it out. Selling this call is going to bring in $1.20. $1, actually 27 cents. This call will pay for my insurance. Also, if Costco closes above 85 in April, I will sell my shares at 85, locking in a gain. I would sell 3 contracts. Alan says, and you can only do that because you own shares of Costco. Not technically, no. You can do this on an option trade too, Alan. But we're doing this with shares right now, not to get too complicated. But yeah, you can do the strategy with options. We're doing good. We're learning here. We're just chipping away at this. Because again, this is back trading. This is what I do when I'm back trading. Is I'm just trying to analyze, like, where would I do this? Why would I do this? I'm getting into my puts because we're retesting a really, really strong support. So I'm buying insurance, right? We can see a little bit of a potential flag pattern here. I'm selling calls to pay for my insurance. Javier says, what would happen if Costco goes below 80 in March? That's a great question. So team, let's imagine, right? Because again, I'm buying the contract. So if I go, we're doing a February 80. So this is protecting us until February. February expiration. $8 strike. So if it takes us until March for this to go down, so let's again imagine that it goes like this and then drops in March, then you're going to be losing on the trade with no insurance. Victor says, are you going out further on the covered call to get more credit? That is correct. So we are buying a February expiration and we're selling April so that way I get a credit on the calls so that I can use those call premiums to offset the cost of the insurance. Albert says, did you buy the put on the initial plunge or on the retest? I bought this put on the day that we are paused on right now. So this day right here on the retest is the day that I'm buying the put and selling the call. January 23rd, 2012. Looks a little bit like a head and shoulders pattern. Looks a little bit on the rough side. So again, I'm going to go forward a day. Let's go forward another day. Let's go forward another day. Another day, another day, another day, another day, another day, another day, another day. So we're going all the way until the February expiration because we're going to learn something for free. This will be a free lesson. Expiration is the 17th of February. Okay. So here is the expiration of our put option. So we bought a put here. We use these calls to pay for that put, or at least offset it dramatically. We sold 3 contracts. So let's do the exact number. 300 times 1.27 equals 381. 400 times 0.85 equals 340. Yep. So we actually did get a net credit on this trade. So we got a net credit on this trade of, I'll do the math again. So this brought in $381. And this contract brought in 400 times 0.85 is 340. So our overall net credit on the option trade was 41 cents. So, or $41. So I'm just going to say so far we've lost $600 on premium. Brian says, are we going to be able to watch this recording? Yes, my dear friend. Don't you worry. Okay. So now at this stage, this option is gone. This option is invalid. It is expired worthless again. So now we've bought 2 put options on Costco and both have expired worthless. This is the 85 covered call that you sold that doesn't expire until April. So if Costco is above 85 on the 3rd Friday of April, we will sell our shares on the 20th of April. So we have right now the strategy known as a covered call. We have a short 3 calls and it's at 85 and the stock has to close above 85. So again, for educational purposes, we're going to press play and just see what it does come April. And then we're going to talk about it. Obviously, it's moved pretty bullish. Right? We're waiting. And it's coming all the way back down and pause. So at expiration, you guys are going to like this a lot. At expiration, the stock closes at 87.58. What happens to our 300 shares, ladies and gentlemen? Okay. We get called away, AKA we sell 300 shares at 85 because 85 was the call option that we selected. Now we bought the shares at 83.58. So we're still making profit on those 300 shares. So let's do it really quick. 85 minus 83.58. Okay. 85 minus 83.58 equals $1.42. $1.42 times 300 shares. And your profit would have been 300 times 1.42 equals $426. So this is our net profit so far. Plus we still have 58 shares that are in the cooker, right? We still got 58. They're just kind of hanging out. So I'm going to come over here to the premium and I'm going to change 600 minus 426. So we are only down $174 so far on our trade where we're putting, quote unquote, all of our eggs in the basket. You guys following that so far? Because that's why I'm bringing this into fruition. I want you to just to see. All we're doing is we're learning for free. And we're practicing the math of this particular strategy. Because this is, without question, my favorite strategy. I will do this strategy on millions of dollars, on tens of thousands of dollars. I will put an entire account on one stock and do the strategy over and 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 over. Even though we're putting in $30,000 just based on the premiums and the options, we are losing, but we've only lost $174 so far. Plus, we still have these 58 shares. Okay. So that means I'm going to delete this line. We're going to come over here and we're going to mention, I'm going to put a box. Still got 58 shares. And so that means to me that we need to get some more shares. So we still got our 58 shares. Albert says, how did you determine the put strike price? So Albert, that's the easiest part about the collar, my dear friend. You don't want to lose a lot of money. That's the answer. Don't lose money. So you want to buy a put option where you do not lose a lot of money on the trade. Simple as that. Nothing else to worry about. You can use support and resistance. You can use your chart, or you can just use math. Where do I not lose a lot of money on this position? So what I'm going to do for our 58 shares is I'm going to go ahead and sell those here. Matthew says, is this your option hedging masterclass? Yes, it is. Hedging with options. Legendary. All right, so we're going to sell this at $87.58 because I just looked at the numbers. I just like the number. So it's exactly a $4 profit per share. 4 times 58 shares is $232. $232 minus 174. So far, ladies and gentlemen, we have an entire actual net profit of $58 now. We are $58 net profit. Oh, big money. So now our shares are gone. This is gone. Everything is gone. And now we have no shares. We have no position on Costco, and we have $58. So now I'm going to go and try to do the exact same thing. Let's go buy it again at this level. I'm going to put in $83.58, and I'm going to walk away, and we're going to see if I get filled on Costco at $83.58 again with the exact same amount of shares, $30,000 divided by 83.58 equals 358 shares. It's going to be the exact same trade twice. And now we're going to start going counter by count. So let's just click play and see if this ends up getting filled at this support level. All right, we're filled. Buy low, sell high. We're feeling good. So this is going to be fun. What I'm going to now do is I'm going to wait. I'm going to just walk away from Costco. And I'm not going to do anything. I'm not going to analyze the candles. I'm going to do absolutely nothing until Costco gets up to 87, which is where it was before. And trust me, there's going to be a reason to all this. So when Costco gets up to $88, which is a previous resistance, then and only then am I going to do something. So I'm going to wait and do absolutely nothing. I'm not going to analyze it. I'm not going to pull up the chart. I'm going to do nothing until it hits 88. So I'm going to press play. And let's just wait here for just a second and see what it does. We're waiting. We're not doing anything. Okay, pause. So now let me walk you through something for just a moment. We originally started getting into this trade in October, right? Right now it's June, so we're coming up on a year. I bought my position in May, and now it's June. So it's an entire month, and the stock has increased in value because I bought it at a nice old resistance, new support. I bought it nice and low. I put my order entries in. This, ladies and gentlemen, right here is what's referred to as the greatest trade of all time. Because as of now, I can create this to be an unlosable trade. Type in a 2 if you want to see how I do it. All right, here it goes. So we're going to go to June 8th of 2012. This is going to be so fun. I love this. Oh, it's the best. June 8th of 2012. And I'm going to go out to July. So this is the July call option. July option chain. And I'm going to look at this and go, all right, remember, where did I buy my options? Did I buy my options lower than or higher than 85? Did I buy them higher or lower than 85? I bought them lower. Okay. Did I buy my stock higher or lower than 90? I bought them lower than 90. Okay. So why do you keep asking me this rhetorical question, Newsome? Because I'm about to get paid to do a trade where one of two things happens. I either sell my shares at 85 or I share my sells at 90. Ability to sell my shares here. This is going to cost me, let's just say $1 on 400 shares. Okay. And then I sell a $90 call option. And that call option brings me in $1.47. $1.47 credit. Okay. So the insurance or the ability, ladies and gentlemen, to sell my shares at 85 is going to cost $1. Does everyone follow me so far? So what I'm going to do is, again, I'm just going to play this out. We're going to go to July 20th just to see what happens so that we can talk through it and I can give your guys, your brain, a nice big explosion. All right. So I'm going to click the play button. We're going to wait and do absolutely nothing. And we're going to come to Costco and here's expiration. Okay. So Costco is at 95. At what price do we sell the shares? So we're selling the shares at 90. So again, we're going to pause here for just a quick second. 90. All right. When we got into this position, there was only there's only three outcomes. So we got into this position on this purple line where there's three outcomes. Stock trades sideways, stock goes down below 85, or stock goes up above 90. If we have to sell our shares at 85, ladies and gentlemen, would we have been profitable on that trade? Yes or no? Yes, we would have. If we have to sell our shares at 90, are we profitable on that trade? Yes or no? Yes, we are. Does that mean that this is mathematically an unlosable trade for the time period that the insurance is available? Alan, what do you think? Alan says, would you not make more money just holding the shares? We'll see. Maybe, maybe not. Maybe Costco comes back down here and you can buy it again. But what I'm saying is you're going to have more risk because you don't have any insurance. I mean, sure, you can just hold stocks, but let's say that you're in Tesla right now and you're just holding the shares. Are you feeling good about life if you're just in shares with no insurance, no protection on the downside? Same thing is if you own a house and you don't have any insurance on your house, it can be a little bit stressful. So the point I'm getting at is if you know that this strategy exists and you know it's available, I think that sometimes it will help change our perception of what's possible because now your risk is extremely managed on a trade. And you can create this strategy where depending on how much equity you have in the position, you can dictate exactly how much you make or lose. How much sense does that make, boys and girls? Alan says, so the best case scenario is Costco tanks and you sell at your put strike. I wouldn't say that's best case scenario. I'd say that's worst case scenario, but yes. So worst case scenario is this would have happened. Costco just absolutely plummets and we sell our shares at 85. Best case scenario is essentially what happened. Stock goes up and we sell our shares for a profit. Alan says, I mean, in this case, the insurance is the most effective. Yeah. I mean, if you want, I generally don't ever want my insurance to be effective. Truth be told, like I don't want my house to burn down. And then I call the insurance company and I go, hey, I need to use my insurance now. I'd rather just have the insurance and never use it personally. But yes, technically, if Costco closes below 85, that's when your insurance would kick in. That was exactly correct. So now you're obviously seeing that the 358 is going to cause some conundrums. So team, could you have just done 300 shares so that you have an easy amount of shares so you don't have to worry about the extra 58? So you don't have to worry about should you buy 4 or should you buy, right? So when you're getting into a trade, that's why people love doing it in lots where they can just buy 100, 200, 300, 400 because it's an easy number, number one. Or number two, right, put more money in than 30 and do 400 shares. Maybe if it's a margin account, you can sprinkle in a little bit of margin so that you can go buy an extra 40 shares or 42 shares so that you can have a full 400 so that you do your protective put and your call on the 4 full 100 shares. KP says this would work so well on long-term accounts. Bingo. Bingo, 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 bingo. I do this on long-term accounts. I do this with large sums of money. This is how I made the majority of my money as a stock market trader, because early on, I would just take every account. I would take one trade. I would buy what I felt like was an extremely strong stock at a really good price that was in an uptrend, a company that I like, use, know, understand, interact with every day. I would buy it. I would wait to get positive equity. Here's the key. I would wait for the stock to get positive equity, and then I would start getting into a collar. And if I get called away, I would do one of two things. Thing number one, I would just look to buy the stock again with either a put sale or some shares, or I would just go buy another stock. Let's call that stock Walmart or Microsoft or Tractor Supply Company or John Deere or Caterpillar or Procter & Gamble or Pfizer or Johnson & Johnson. You guys following me?